not be considered as well?
In case of payback method, we normally don't consider the rate of return. We only consider in how many years we can get back. That is the reason we have to couple this payback period along with the NPV IRR, which are the time adjusted techniques. And we can say that how many years you're going to get back your money. That is what your payback is actually going to answer the question. How much return you're going to get, your IRR is actually going to telling you that. So all the methods we'll be discussing in today's session. Is it fine? Okay. So next is these techniques take into consideration of time value of money, as it has been discussed already. There is a discount rate at which the project future cash flows are discounted back to the present value terms. So you know that it is a WACC. It is. So they take into account all the benefits and costs accruing during the entire life of the project. So what are the various time adjusted techniques we have got? Is the NPV, IRR, discounted payback, or maybe payback, MIRR, that is modified internal rate of return, profitability index. These are the various time adjusted techniques we have with us. So we'll be discussing one by one. So DCF techniques recognizes that the first one is DCF technique recognizes that the cash flow streams at different time periods differ in value and can be compared only when they are actually expressed in terms of common denominator, that is present value. Okay, how are you going to compare 3-4 cash inflows which are coming up with different time horizons? It is very difficult to compare. So because of that reason, we are going to use the time value of money technique, so that every other cash flows will be compared on a single time scale. Maybe t is equal to 0, or maybe t is equal to 1, or maybe t is equal to 5. Everything else, if come into common denominator, then only we can compare. Otherwise, we cannot really compare. That is what is the fundamental thing about the present and present value and the future value, as you already know it. Because since we already know what is time value of money, it is easier for us to discuss the various concepts of the time adjusted technique. Okay, so the first method is the net present value. Yeah, anybody has got any information beforehand? Tell me what do you understand by net present value, just in case if you know what is NPV.
So it is the total value of the, the total present value of the different years inflow. I mean,
Okay.
Inflow minus the outflow.
Inflow minus the outflow. Yes, Abhishek, you're almost there. 95% is right. Another 5%, let us see what is it. So Vaibhav is saying that difference between the present value of cash inflows and the outflows over a period in time. Yeah, very good. So we'll see that what is it for others, those who don't know what is it. Okay, so NPV is found by subtracting the present value of the cash inflows from the present value of cash outflows. These cash flows can be discounted at the firm's cost of capital, that is WACC. Okay, let us see symbolically what is it. So please try to understand what is this symbolically as well. Okay, so NPV is equal to what? NPV is equal to, this is summation, T is equal to 1 to N. What is T? T is equal to 1 till N it is. CFT means what it is? CFT is the cash flows at different time periods. Okay, so which means this particular notation is all about what? Present value of incremental cash flows. Okay, so you have invested let's say 10 lakh rupees, and you have got you'll be getting, let's say a series of cash flows over a period in time. Okay, what you do is, this is actually called this CFTs are actually going to be what? The series of cash flows. Okay, what are you going to divide by? You are going to divide it by 1 plus k whole raised to t, which means you are going to convert all this future cash flows back to the present value terms. That is t is equal to 0. Is it clear? What is t? T is equal to 1 to N it is. Okay, in other words, the first notation is your present value.
Sir, what is the difference? Means whatever the previous NPV we have read, so if you will compare to this, so it is coming different. So is there any difference in this NPV and previous NPV?
What is previous NPV? This is the first NPV we are discussing. Right? We have not discussed at all what is NPV so far. This is the first time we are discussing.
Okay.
Have you discussed by any chance NPV in the previous classes? Correct me if I am wrong.
No, we only discussed PV.
Yeah, we only discussed PV so far, right? Present value. Okay, the first notation is all about your present value. It is the first notation after NPV. This is the first notation for me. Okay, this is the computation of PV. It is nothing else, nothing great. It is. Yeah. Any doubts with respect to first notation? You can ask me. Okay. So CFT stands for what? The incremental cash inflows which are happening at T period. T means T may be 1, 2, 3, 4 trillion it is. Divided by K means your WACC it is, or risk adjusted discount rate it is. Okay. So raised to T means what? It can be 1, it may be 2, 3, 4 trillion it is. Is it clear? And what can be CF here is, what are the cash flows means? The cash inflows can be the working capital which will be utilizing, which will be investing at the T is equal to 0. That is also going to be get released at the last year. Okay. And what happens is, let's say you bought a machinery of $1 million. Okay. And once you sell off that particular machinery, you'll get something as a scrap value. You can sell it as a scrap value, right? So 1 million means, which means you can even sell it for $500,000 also. So that $500,000 is actually called as what? Scrap value. Okay, in finance terms, it is also called as what? Salvage value. Understood what is salvage value? Salvage value means if you take that machinery and sell it at the end of 10th year, okay, so your scrap dealer will pay you $500,000. Okay, and that is actually called as what? That is actually called as what? The scrap value or salvage value. Okay, actually $500,000 is on higher side. What I told you, it may be not more than actually 1 lakh or 2 lakh as such. Okay, or maybe $50,000 as well. Okay, so that you have to be keeping in mind. What is salvage value with respect to cash flows? Understood? No. Tell me what all comes under CFT. Quick, we discussed just now.
So loans.
Loans. What are cash flows from your what are the cash flows will be there?
Sales.
Retained earnings.
No, what are the CFT stands for here?
Cash inflow.
Cash inflow.
Cash inflows, right? Tell me what are the cash inflows? What are the types of cash inflows?
Sales.
So
Rent.
inflows from operations, inflows from financing, and inflows from
Dividend.
investing.
No, we discussed very prominent things. One is working capital release, and the second one is we also discussed about the salvage value. These two things you don't forget. Okay, so if you are interested in knowing what is CF, cash flows, how to compute the cash flows, I just go down. So I just kept it as a last slide because we already discussed enough in the some of the previous session. That is the reason I thought just a minute. Yeah, is it visible? Cash flows means these are also called as CFATs. Cash flows after taxes. You can see revenues are there for your company, less operating expenses. What are the operating expenses? Here, all the expenses like labor, material, depreciation, etc. That is what is your operating expenses. And if you net out the operating expenses from the revenues, you get the operating income, which is also called as EBIT. That is earnings before interest and taxes. Okay, if you net off if you take out the taxes, then what you get is actually called as NOPAT. We discussed this while we did the valuation of Britannia Industries. Is it true? Is it correct? That is what we did, right? You know what is NOPAT, right? NOPAT, and you added back the depreciation and the net capex you have actually deducted.
Sir, in
And
case
next
of
is
new
less
eminence,
change in the
suppose
working capital you have deducted.
Alternatively, you can choose to put
And
it in
now
the chat
I'm
box.
saying add the
Okay, so
salvage
there are
value
two
of the
types of
investment. Salvage value means scrap value. Okay, and one more thing to add is working capital release, which I have not mentioned it here. Okay, so if you want, you can write down that as well. Okay, so working capital release, add.
So this so salvage value, if there is some machinery that is sold before scrapping, is it also considered in that?
No. While we'll come to that. Yeah. So if you are selling it off, let's say, then it becomes modification or disposition. It is right.
Right.
So that is the reason it is not been considered as a scrap value or a salvage value. So maybe you are actually buying one more machinery. That is the reason you are selling it off halfway. Right?
Yeah,
So
sometimes
that
what
comes
happens
under
is
the,
when the project
that
is
comes
over,
under the,
let's say, so
if the project is over.
entire machinery is released, or you can say replaced. Sometimes it
Huh.
happens.
See, if supposing that if you want to modify it and if you want to use it, then it is not called as a scrap value.
Not modify, because what happened was that in pilot cases in chemical companies, if you say so, pilot cases, the entire machinery is taken into, and if that pilot is successful or reject whatever, so when the process is completed, that machines is rejected sometimes, or part of it is kept and part of it is rejected, and new reactors and new items are bought in. So is a scrap for the organization, but it's not its life. Maybe within 1 year it may happen sometimes.
Then I have to check, because normally at the end of the life of the asset, if you sell it,
Basically it's a resale.
are you going to, you tell me whether are you going to sell it to a scrap dealer? My simple question.
No, sometimes the providers, the manufacturer takes
Then
it back.
it is not the scrap value then for me. If you are going to sell it to a scrap dealer, then it is called as a salvage value, going by the definition.
Okay.
So
Sir, what is
which
net
means you are actually going
capex?
to abandon that, right? You are not going to going ahead with the project, right? You're going to abandon
No.
the project in between because you feel that that is not really going to be working out.
Yes.
Yeah, then it is not called as a scrap value. Yes, Rekha.
So what is net capex? Capex is the investment in capital
Yes, capital
expenditure.
expenditure means you are buying a land, machinery. That is actually capex. Net capex means net of depreciation.
Okay, sir.
Clear?
Yes.
So
Okay.
that
So
is
why are
value
we going to add
depreciation
this
will be
working capital release here? Anybody can tell me why working capital release is actually going to be added here?
the
So
part of
working
capital that
capital
will
is
be
a
released.
liability.
No, you're actually investing additional working capital if you're actually infused at the T0. T0 mean today. You're actually taking up this particular project today. And for that reason, you require some additional working capital, right? Since you're installing a new machinery, then if you don't have additional working capital, how are you going to
Yes.
deal with that? Is it not?
Yes.
And once when the life of the project goes off, okay, it is believed that the working capital what you have invested will come back to you actually. What you have invested at T0.
Yes.
Is
So
that
that is
operational expenses you're talking?
not
That
operational
will come in
expenses.
operational expenses.
So working capital release means you can think of this way. Okay, so since you are actually started a new line of business, okay, you have to give credit to your let's say customers. Okay, and what happens is customer is actually not going to repay you. He keeps on taking it again. He'll be giving it to you, and it keeps on happening every 90 days. He's actually going to take back. He will actually take the money, raw material, and he's actually pay you. And that 1 month's what is there, that is something which is actually going to be not been actually it is there in the business itself. It actually circles around like that, and it releases back once that particular life of the project ends. Okay, that is actually called as what working capital release.
Cycle of the basically market cycle.
Yes. Okay, that is the reason working capital release will be adding at the end. Okay, we also add that to the investment, and also in the last year we are also going to release that, and we are going to add it back to the in the last year. Okay, is it fine?
Sir, one point. You are
Yes.
referring capex as a net of depreciation. How? Just I
Yes.
just want to understand. Like that is the capital expenditure what we are going to do. So how it is going to be net of depreciation?
Depreciation we are already added back here, right? Because that stays in the business.
Sir, I have also the same question that first, as we are minusing materials, that means the machine which we had bought, we are subtracting. So you are adding in next year that in the form of depreciation, that how much the value still remains.
So why are we adding depreciation here in the first place? Anybody can answer this question?
Because then ultimately, physically, there is no money going out. It is there, and
It is
it
a
is
non-cash
reduced.
expense, right, Sachin?
Yes,
It is a
non-cash.
non-cash expense. It is. So that is the reason, since it stays back in the business, we are going to add back that. Preeti madam, is it fine?
No, sir, I did not get it.
Okay, tell me depreciation, are you really paying for the depreciation? In other words,
No.
which means since accounting rule says you can actually take depreciation, that is an allowed expense, you can actually take as a deduction before computing your net profits. Allowed expense it is. Allowed expense which is non-cash. You're not paying for it. Because non-cash means, in other words, you're not paying for it. If you're not paying for it means what? It stays in the business, right? That is the reason we are adding back. Because we can, those are also counted for the cash flows. Is it clear? Sumit, yeah. You want to say something, Sumit? Can you please mute yourself?
Sir, what about
think I muted.
labor, materials to be written in this?
Yes, Naresh sir, go ahead.
Labor, materials
Huh.
written.
So why are we deducting this?
Yes.
So because you have to come up with an operating income, right? Income means it is something like a revenue minus expenses, right?
Okay.
Then only you'll get to have an income.
Okay. All these are less labor, material.
Yes. Less operating expenses. What all these operating expenses? Examples are labor, material, depreciation, etc.
Okay.
Is it clear? This is a heading. Under that, these are the items.
Okay.
Fine.
So PAT is profit after tax. What is no PAT?
Net operating profit. Net operating profit after taxes. Means taxes are netted out, right? From operating income, they're only netting.
Your depreciation is you're minusing in operating expenses, and again you're adding depreciation.
Yes, we are adding. That is what we discussed just now, right, Vikram?
Yes, sir.
Tell me somebody why depreciation is added back, why we deducted, and why we have again adding. Why this all confusion? Please go ahead and tell.
It will be more clear with examples. I think in Excel, if you will do some example, it will be more clear at that.
No, I have explained you actually. And this example also we have done in valuation actually. That also we have done it, right? Go and see if you have got that Excel template. It is also there put up on the Moodle. See exactly this is what we have done there actually.
So
the revenues we have
is,
taken, operating expenses we have deducted, then we come out with the operating income, EBIT, then we have deducted the taxes, and no PAT we have actually come up with. And then what we did is CF8 is also, CF cash flows to the firm also we have computed. You can just go through that example, you will get to have information of complete example.
so basically whatever the depreciation we have on any machinery or whatever, it is not become reflected in the statement. But on the next year, what we have, the net value of that particular is going to be less.
Yes.
Machinery. But
Correct.
when we are going to prepare our income or income statement, that is not going to reflect there, your depreciation, because it is kind of a virtual value which is not coming to you, but it is depreciating. Okay. So
yeah, it's a non-cash item. Since it's a non-cash item, since we are not paying for it, we are actually counting it as a cash flow. See, it is simple. It is if cash is coming in, that is a plus item. If the cash is going out, it's a minus item. It is. Okay, less means minus, add means plus. It is as simple as that. See, add depreciation. Why are we adding this? Because we are not paying for it, so we are counting it as a cash flow. So capex means the cash is going out of the business. So less. That is the reason less capex we are doing it. So next is change the working capital. There is an adjustment that has been happening. That is liabilities, the current liability. It's an interplay between the current assets and the current liabilities. It is anything there is a change. Okay, if let's say cash is going out, okay, we are deducting all those, and if cash is coming in, we are going to add that. Okay, so and that is actually the net effect we are taking into consideration as change in the working capital. Okay, and next is add salvage value because cash is coming into the business. Working capital release, cash is coming into the business. Fine.
So after no PAT, depreciation is adding, and in net capex we are deducting the depreciation. So in the equation, depreciation will not be there. Only capex investment is there, sir.
Yes,
in this equation.
Yes, yes. So you can see the less capex means what? Yeah, whatever the money which you have expended from you for the, let's say, land, building, anything you have purchased and paid money for it. So that is the reason money is going out of your business. So that is minus figure it is.
The same depreciation you are adding and the same depreciation you are netting off from the capex, sir. The same amount.
No, I'm saying that if supposing any new asset has been bought,
Yes.
okay, that is only we are taking it as a capex here.
Okay.
Which means,
Okay. Oh, that depreciation is whole depreciation and net capex is for the new capital expenditure depreciation.
yeah.
Okay.
For the, supposing if it is a sunk cost, what do you mean by sunk cost? Investments made in the past years we're not going to take into consideration. Okay, investments which are made in this year only will be taking into consideration. Supposing what happens is in some years there is no capex at all. Okay, so that item will be zero there. Fine. So let us move on because we have consumed so much of our time there. Okay, so you can go through the material. If you have got doubts, you'll be able to understand that. I'll be going back where we left off. So we were here, right? So CFT, there is no doubt now. And K is your cost of capital normally, WACC. Minus COT means what here? Minus summation T is equal to 0 to N. You can see the difference. Here summation T is equal to 1 to N we have written. Here we have written T is equal to 0 to N. So why is that there is a difference there?
Because equity also comes with capital.
Initial investment.
Initial investment happens in T0 only. It does not. So the moment you make an investment, the cash flow will not happen. That is the reason we are actually T starts from 1 here. So here what happens? COT means what? Cash inflows at, sorry, COT means cash outflow at different time periods. It is. Cash outflow can happen at T0, T1, T2, T3 and so on. Okay, but cash inflow will not happen at T0. So that is the reason we have taken into consideration of T1 to Tn. Is it clear, everybody? Okay, if this particular equation is bothering you, if you still not understood, nothing of it. Okay, so you can just have a simple thing. I think Abhishek sir has actually given this equation. He has written somewhere in the chat box, right? So present value of cash inflows minus present value of cash outflows. Okay, if you do these two, okay, the resultant figure is your NPV. Is it fine? What is NPV? NPV is present value of cash inflows minus present value of the cash outflows. Simple it is. Okay. So what if the NPV is negative? What we have to do? Lesser than 0, right? Negative means lesser than 0 it is. NPV can be two things can happen. NPV is lesser than 0, NPV more than 0. Okay, if NPV is more than 0, positive NPV it is. Positive NPV means you have to accept the project it is. Negative NPV means you have to reject the project. Is it clear? Okay, so let us take up this particular problem. It has already been posted. You guys can actually go get it. I am going to just copy this. And I am going to move to Excel as usual. So 12% and 14%. WACC is 12% and 14% given in the problem only. I am not doing anything here. Okay, so let us go and do for the machine Y, machine X now. Okay, so what I do is I'll write here year and the cash flows. Do along with me. So I'll start from 0, 1 and so on. And the project is for the 5 years. So cash flows are readily given to us. Cash flows after taxes. Okay, so how much is at 0x? It is minus 2,50,000, correct? Plus what? So you can see the additional working capital required. We have to be accounting for that as well. So total, how much we have expended? Okay, so investment is 2,50,000 plus additional working capital required is 50,000. So 2,50,000 plus 50,000, we added both of them and we got it as 3 lakhs. Clear? Any doubts here? Next. So what I do is for the next 5 years, I'll just copy and paste the cash inflows the way they are. Fine. So what happens here at the 5th year? What we should do? What should be added? Salvage value is 1,500. Very good.
Yes.
And next is working capital release. Okay, 50,000. So I'm adding salvage value and the additional working capital in the 5th year only because this is my last year. Any doubts until this? You can ask me.
This working capital required will be added. Okay.
You can see the working capital release we have added and the salvage value also we have added with the last years, that is 1,13,700 we have added.
But working capital release is not given.
Working capital release is
Not given.
it is not given, but it should be implied. It is always.
This is equal to working capital required.
Additional working capital, whatever it is there, what has been required, that is all the time it is released. You can go study any of the corporate finance textbooks. It is given in every other textbook. It is okay because whatever you actually invest for the working capital, that is actually normally released at the end of 5th year. As I told you, you are actually paying for your customers. Customers are actually taking some goods on credit basis. For that, you might require additional capital.
It can be in the form of cash or all that. That working capital which are
normally
required.
The working capital is in the form of funds only.
Okay. There is no depreciation in this. Okay.
No depreciation. It is it's a cash. In other words, it is an cash working capital. It's not a non-cash working capital.
It can be inventory also.
So working
Yeah, that is
capital
what the
can be
inventory I'm giving
also
it
raw
on
materials.
inventory I'm giving it on a credit.
Okay.
And for that money is the inventory is valued in terms of money only, right? Is it fine?
Sir, just to confirm,
Sir,
which
working
problem you are
capital-
referring? From where you have picked this problem? I'm just searching in the presentation.
Once you are not audible actually. Hello.
Yeah, from where you picked this problem? Because I'm searching this problem, this particular problem.
Okay, you can go to LMS.
I've
Shall
just
we go to
seen
LMS?
I've just seen the presentation and all.
Go to LMS.
Yeah, I'm in LMS.
Is LMS is visible to you?
Yes.
Can you see this class PPT investment decisions, last one, 10th and 11th?
Yes. Okay.
Is the same is visible or something else is visible to you? Because this is how it is visible to me. Is it also
Yes,
same?
it is. Yes, yes.
Is it there or not?
It's there.
It is there.
Okay,
PPT
sir,
is
because
visible.
I
Can you just
opened
click on this?
Yeah. Okay, sir.
The same PPT, it is there here. I have posted. So how many of you got this PPT? Just put it in the chat box as yes, because I'm confused.
Because the one PPT what we were discussing on the theoretical part, and this is the another PPT.
Same PPT, it has already been posted. Okay, many of you already got it. Okay. Fine, I now clarified. Let us move forward. Is Excel is visible now?
Yes, sir.
Sir,
Yeah.
on which page of that PPT this question is? Which slide of that PPT?
So you can see
Slide number
16.
15.
16, right?
On uploaded PPT, it's coming slide number 15.
Yeah, because I have inserted one more slide, I guess. After I must have updated the PPT.
Yes, sir.
Fine. One or two pages here and there, you'll get that. Fine. Is it fine? You have to search slightly.
Yes, sir. Yes.
Yes, sir.
Okay. So shall we move forward?
Yep.
Okay. So now how to compute present value of cash inflows and present value of cash outflows? Because present value of cash outflows is clear. There is only one cash outflow. And these are the series of cash outflows, it is, right? Can you find out the present value of the cash
Last
outflow?
you can more means one celebrate like why we are adding 1500 and 50,000 into this because earlier
1500 is
50,000 we
your
have
salvage value. We discussed it is in the format. Salvage value will come back to you once you.
I'm asking like why 50,000 is adding means at the 0 year and also in the 50 years.
So working capital is normally you invest at 0 year and that is going to get released in the 5th year.
Sir, we can say in layman term, आपकी pocket से क्या गया और क्या आया आपकी pocket.
Yeah, what you invested you got back. That's it. Okay, it is actually possible only in case of working capital. And what do you mean by salvage value? Because this 2,50,000 became 1,500 as a scrap value. You have sold it to a scrap dealer. Is it fine? What is scrap value? Salvage value. Class, if you tell me, then I can move forward. Otherwise, I'll be stuck here. I'll be here only. You tell me whether I can move forward or you want some more discussion here.
Yes, please.
Shall we continue?
Yes, sir.
Yes, please.
Okay.
Yes.
So now tell me what is NPV? NPV is equal to present value of cash
Inflow minus
inflows minus present value of cash outflows. OF stands for outflow. Okay. IF stands for inflow in finance. Okay. So tell me now, how much is your NPV? Everything else is there in front of you. Only thing is you have to compute and tell me quick. I'll give you 2 minutes time. Let us see how many will do this. Because why is it I'm giving it you to do is, you know how to compute present value and future value. And you are thorough with it. That is what is the assumption I'm making here. Rekha madam, please tell me how much is NPV. You know in front of you what is NPV.
Sir, we are at 0 year now. This 5th year is our futurist. We are thinking about future. This will be our cash inflow.
Okay, Naresh sir, please do whatever the assumption you want to make it. You solve it and tell me how much is NPV. I'll explain you. Okay? Don't worry about it.
Okay.
Please try and get the answer. Let us see. And put the answer in the chat box. Let us see. Anybody got the answer? Okay, so Nirankar has got minus 4,54,000 and odd. Okay, so those who don't know how to do it, so please concentrate. So I'm going to do now present value of cash inflows. Okay, I'm going to do this now. Okay, so how to do present value of cash inflows is equal to present value. Rate is how much? 12%, that is fixed. N per is 1. PMT skip minus This is future value. Okay, so we got we have computed the present value of this. Only this one. So I have to do present value of all this now. I have to compute. What should I do? I just double click, or I have to drag this. So now I make a summation of this. Okay, so this is what is my present value of cash flows. Cash inflows, incremental cash flow. These are actually called as what? Incremental cash inflows. So how much is the present value of the cash outflow? Anybody? This is equal to this, right?
Same.
Huh? So make a summation of this two. Are you getting the same answer as mine? Nirankarji, how you got this answer?
We are at 0 here.
Just see.
Actually, I have calculated for 50 years, not considered every year individually. So I just considered 50 years, and based on that 12%, the rest is okay. I have not calculated for first year, second year, third year, and fourth year.
Okay. So you have to calculate, right? For all the years, it should be computed. So because t is equal to 1 to n, it is t is equal to 1 to 5. It is 1, 2, 3, 4, 5. These are t's, right? So how many have you got now? Minus 21,176 as answer. Getting it, no?
Yes. There is a negative. Yes.
It is negative. So this is our NPV, right?
So we should not.
What is the decision here?
Should not invest in this program.
We should not invest. That is the decision, or we can say that simply reject. Is it fine? The project should not be taken into consideration. This is the broader concept of NPV. So shall I explain you how to get this 2,78,824 in one single step? Is equal to NPV function. Okay, so 12% is the cost of capital. Okay, so select whole of this, enter. Are you getting the same answer now? You must have seen we have used NPV function in directly in valuation, last part of the valuation. Do you remember now? How many of you remember this NPV function which we have used in valuation? Valuation of Britannia Industries. No, none of you. Go check the Excel sheet.
Yes, we did.
This is the same. So instead of doing the one by one calculation, we can get this in one step only. Okay. So supposing that instead of 30, 42, 52, 59, 93, assume that everything else is, let's say, 30,000. All are 30,000. How you would have done this? How you would have done this? Tell me, quick.
Straight away subtract the 1 and 1.5 lakhs.
No, these are happening at 1, 2, 3, 4, 5 years. These are not happening in year 1.
Okay.
How you would have done this? You would have done still using NPV function. Okay. Supposing if you did not know NPV function, assume so, how you would have done this?
So please repeat the question.
By using the PV function, rate is 12%. N per is 5 and TMT is 30,000. Because it's a PMT, right? Okay, don't forget what you have already discussed. Is it not? PMT, you know, right?
Fixed amount.
fixed amount. Supposing even if you don't know NPV, you should have done it using PV function because it's a PMT, because it's a PMT it is, annuity it is. Clear? Don't confuse, this is not part of the question actually. I have created my own question. So NPV can be used. Okay. So can you compute the machinery Y? Quick.
Sir, please show the table. Actually, I have not opened the thing.
This one.
Yes, yes. Yes, yes. Okay.
This is Y. We have just done for X machine and we have to go for Y machine now. Can do it in one step. If everything else is fixed.
Yes, by direct NPV.
Yes. So I am doing for machine Y here. So I'll just copy here. And I paste it here. Only this will change, right? I think somebody has already given the answer. Deepesh is saying 1,51,437. Soham is saying 33,259. Let's see. So how much is cash flow here? $2,55,000 plus how much? 50,000. And this should be a negative figure, right? Is it correct? See. And next is what? We have to just copy paste. And what happens here in the 5th year? Salvage value should be added. Plus working capital release should be added. Are you getting the same in the cash flows? If these are correct, can you compute NPV now? NPV is 12%, sorry, 14%, right? Cost of capital. And then these plus this, because I'm putting plus because it's minus symbol it is. How many of you getting this much? So decision is accept now. In one step you are getting, you can see. Okay, so 5.
Sir, I have a question. How do we
Yes.
compute if we are getting some amount year on year back? For example, my parent company is investing some 10 lakhs. I'm audible?
Yes, yes, yes.
Yeah,
You're
my
audible.
parent company is investing 10 lakhs in a machinery, and year on year they might get some, 10,000 every year. So how do we calculate in that scenario for 5 years?
Okay, so I'm writing your question here directly. Is it fine, Sharath sir?
Yes, sir.
Just a minute. So tell me minus 10 lakhs, right?
Yes.
And next is?
So we can keep this same, the cash flow, but the investor is getting some 10,000 every year.
Mm-hmm.
That
How
means
many
I'm
years
paying
he's going to get, tell me?
for 5 years.
That's it, na?
Okay. So,
So
but this is
tell me how
working
much is
capital.
how much is the rate of your WACC, your company's WACC?
So 12%.
Huh?
12% we can consider.
12%, fine. So now you take up this incremental cash inflows plus 10 lakhs. Okay, so NPV is negative. You tell me what to do.
No, this 10,000 is my, actually the investor is getting back. When we are speaking about here cash flows, this is the cash flow of the company, right? Where I have invested. But
No,
this is the profit kind of a thing.
cash flow for this single thing can be done. See, because every division is actually going to be different, right? So divisional WACC can be used at that point in time. Not the firm's WACC should not be used. Company has got various division, and for every division there's a WACC that can be computed. Okay, and for that particular division only you can actually do this particular assessment. Okay, the CF8 is how to compute it is the same. Yes, Abhishek sir, tell me.
Sir, just one question. These general cases, there's a single year, T0 is the outflow and T1 are all inflows. Supposedly, the project involves an outflow in year 2 as an expansion, which is mandatory. So that again will be taken as the present value of that outflow and added as. Is that the right?
Supposing that here, let's say for example, what you do is, this is your cash inflow, right? Minus, assuming that you are going to put 1 more lakh here. So it is a minus symbol, right? You can see.
That will be net.
Okay. You can see NPV automatically it is taken into consideration. Is it fine?
Yes.
Hope that is clear. So now we are going back to so JSW Steels, it is the same problem it is. Hope everybody must have understood what is NPV now, right? So different numericals, but everything remains the same. Okay, so you can do this, I guess. So there is one more problem. You can do this later on. Same. So let us see, NPV is greater than 0 except the project, lesser than 0 reject the project we have discussed. So 0 NPV multiple implies that the firm is indifferent to accept or rejecting the project. So decision rule, as a decision criterion, this method can be used to make a choice between mutually exclusive projects, as you know. Okay, so what is mutually exclusive project? If you consider one project, automatically you're rejecting the other one. That is actually called as what? Mutually exclusive it is. So on the basis of NPV method, the various proposals would be ranked in the order of NPVs. Okay, highest, supposing if you've got 5 projects, okay, you can compute NPV and rank them. Higher the NPV, rank number 1 and 2, 3 and so on. Okay. So the project with highest NPV would be assigned with the first rank and so on, as I said you. Okay. So what are the various merits of NPV? Let us see. The most significant advantages, that is, it is explicitly recognizes the time value of money. That is very important. It also fulfills the second attribute of a sound method of appraisal, in that it considers the total benefits arising out of the proposal over its lifetime. But in case of payback method, which we'll be discussing later on. Supposing that if payback happens just in 3 years, we are not going to consider rest of the years, right? So that is actually the reason it has been kept here. The changing discount rate can be built in into NPV's calculation by altering the denominator. So like, what if the project has got, let's say, 15 years time horizon? In that 15 years, what can happen is your WACC can change, right? In 15 years. So what you can do is you can actually inbuilt that in the denominator itself. You can change the WACC, let's say, for the next 5 years, if you feel so. So that is that particular, what is it, thing can be accommodated in case of NPA. Understood what I am trying to say? Altering the denominator means you are changing the WACC. Okay, instead of 12%, you can go for next 5 years. First 5 years 12%. Next 5 years it can be 14% WACC. Okay, so that can be inbuilt into the equation itself. That is what is the meaning of this. As normally discount rate changes when the project's duration is longer. Okay, because when the project duration is quite long, what happens is the discount rate tend to change. Okay, so what are the drawbacks of this NPV? Is the calculation of required rate of return to discount the cash flows. Okay, so that is one thing. So WACC should be computed. Okay, we can't really say that's a drawback, but that is really required actually. So NPV method gives the same decision for two different projects with a different project life. Okay, so supposing that the project A is, let's say, 5 years and project B is 10 years life, NPV for both the project is 12,000. Okay, your common sense is saying that 5 years should be taken into consideration, right? Assuming that the cash outflow is the same. Okay, so that is how we should be taking into consideration. So next comes the internal rate of return. Shall we go to the next one, or you want to compute one more problem with respect to NPV, then we move on to the IRR?
I think we can move for IRR.
Yes, because NPV, how much ever the problem will be taking, it is all the same. It is okay. Only thing is you have to understand the concept only once. All the other things will be same.
Sir, in case of if WACC is changing in slab after 3 years, 4 years, we are changing the WACC.
Yes.
In Excel in NPV formula, then we have to
change the rate. That's it.
Calculate it 3 times, 4 times. Like there is a 20 years of horizon. Then I have to calculate 5 years WACC is changing. So I have to calculate NPV 4 times.
No, if it is 20 years project,
yes.
Okay, what you have to do is every 5 years, let's say WACC changes. Assume that you are thinking that every 5 years the WACC changes.
Yes.
Okay, so that you can inbuilt into the equation itself, right? Shall I show you that?
Yes, please.
So I'll take this lengthy one. Okay, so what I do is I'll take into consideration of is equal to PV. Assume that 10%. I'm sorry. So PV n per is 1. Assume that third year this changes to, let's say, 14%. Okay, so 14% for the next 3 years. Let's say this changes to, let's say, 16%.
NPV formula will be same.
No, NPV cannot be used there, no? Because your discount rate is changing.
In this
what is this? Present value of cash inflows.
Okay, now understood. And it was talking about the NPV for
Correct. Understand, no?
Yes, sir, yes.
So how much is this? This much. So I'll go and do a summation of these two. So NPV is equal to minus 27,000 and odd. So we should reject the project. Is it clear now how to do it?
Yes, sir.
But only thing is, for every 5 years, what we should do is you should assume that what should be your discount rate. So that also, that particular is a challenge. Computing that is actually again a challenge it is. Okay, so keep that also in mind. That is also one of the challenge, because now it has been given to us 10, 15, 16 easily you have computed. So computation of WACC for the varying time periods is also challenging there. That you have to be keeping in mind. Okay. Yes, we have got two more, just 1 minute. So let us come back after the break. Is it fine? Or before that, if you've got any question, you can ask.
So just click on this red digit NPV
Which
equal
one?
to the Excel which is being displayed, the red digit NPV equal to.
This one.
Yes.
Okay.
Sum.
Okay.
This and this are added.
So then why it is being displayed in negative? Because the positive number is higher.
Is it? Now see.
Okay, sorry.
So that is fine.
So why WACC is called discount rate?
Why?
Why WACC is called discount rate?
Yeah, because we are actually using that WACC for discounting the future cash flows. This is actually called as discounting, right? What we did is discounting. So which means 15,400, which you'll be receiving in 8th year. Okay, if you discount this back to the present value terms at T0,
Okay.
this is only worth
In today's is
4,697.
4697. That was discounted. Okay.
So that is the reason we call it as discount rate. We are going to use that particular rate to discount your future cash flows. Fine. Fine. So shall we? Yes, Abhishek, sir.
So one quick question, there were two methods for computing the cost of equity, and each had its own limitation. Are there some scenarios which are here we're talking about 5 methods? Will we also be discussing which will be more appropriate to really compute when?
See,